Good afternoon again, everyone. I think we've discussed a great deal about multiple investment opportunities, and now this is the last session, but I think it's going to be an absolute banger. We're going to have very crisp, actionable takeaways as to how to build portfolios that are solid, future-proof, and that blend both global and India opportunities. So just to give a quick one-liner about our panelists here. So Akhil is the equity mind, so you should definitely catch him after this for insights related to that. And Debasish lives and breeds mutual funds. Pratik here is a global macro allocator who strategizes really well, I might add. So NRIs today don't just live global lives, they live multi-currency lives. They live in one country, they live and earn in one, they send their children abroad to another, they dream of retiring in another country, and then they want to invest again in another country. So with all of this complication involved, how do you really allocate or invest into India or global? And I think that's the billion-dollar question for today. I'm going to start with Akhil. Akhil, in simple forms, what would you say is the formula to global or India? And might I add that there are inflation, currency, and interest rate swings. Within all of that, how would you look at India versus global?
Thank you, Archana, and congratulations. Very good presentation, super work. So, just to stick to the topic, I think if we just take what has been happening in India for the last 5 years and what's happening in the world. So let's say post-COVID, let's not go before the COVID era. I think clearly with all the massive reforms which have been done with the ruling government over the last 10 years, I think India has got a lot more stability, a lot more secularity in terms of its GDP growth. So over the last 5 years, we've been continuously, consistently the fastest growing economy, and we have doubled our economy from $2.5 trillion to about $4.2 trillion, right? Our per capita income has gone up by about $1,500, right? And we were having a sticky inflation issue, but over the last few quarters, you're seeing that today the inflation has come near to zero. We have seen Reserve Bank of India doing 3 rounds of rate cuts, and if the inflation prevails at these levels, in fact, they're trying to bring in inflation by doing the GST reforms, people spend, and inflation comes back. We expect a few more rounds of rate cuts to happen. Typically, a good formula for a bull market is high growth GDP, low inflation, low interest rate. It's a perfect formula, right? Apart from that, if you see a lot of other macro data points, such as 10 years back, India's forex reserves used to be about $150 billion. Today, it's $700 billion. It brings a lot more stability, right? No doubt, our currency has seen depreciation. Ideally, it shouldn't have seen, but that's more tactical because of the FI outflow, which has been happening for a year. The rupee has got depreciated. But apart from that, we feel that rupee technically will depreciate at a lot lesser pace compared to what used to happen maybe a decade or 2 decades back. Manufacturing data, all reforms, everything, whatever you talk about, everything is looking very, very steady state for us. So I think the macroeconomic data points compared to the world and compared to the 2 large economies, which is US and China. So China growing at 4.5%, US is actually degrowing, it's gone a little bit below 2%. Thanks to all the tariffs, what has been going around, we've seen that US has started to import inflation. And now they're trying to cut tariffs for certain products such that the inflation comes down. And if the inflation is going to be moving up, therefore, I don't know whether the Fed will actually cut rates in the near vicinity at least. So US going through its own situation while their equity markets are doing well despite the macro not doing well. In India, the macro is doing well, but the equity market is underperforming. China, largely because of very, very cheap valuations, it got a little bit of a re-rating. But again, when you talk about economy and sectors and what is doing well, it's very difficult to understand. So right now, I feel that India is well poised for a very sustainable long-term growth story. Even if we compound our economy at the same rate, what it has done in the last 25 years will be a $30 trillion economy in the next 25 years, right? And as the economy will grow, everything will come alongside. So we are seriously into the game now. Yeah. We are the 4th largest. Maybe next 12 months we'll be the 3rd largest. and we will remain third largest for 25 years. So the gap can
absolutely,
reduce.
yeah.
But at these levels, it's very difficult for anybody to ignore India.
Yeah, true. Very well said. Debashish, moving on to, we did see what is the India global view, but are you actually seeing NRIs moving allocation to India? And, how does it look like now? How is it going to look 5 years from now?
Thank you, Archana. First of all, tolerate me for my bad throat, which I have imported from India. So, the topic that NR or R, resident or non-resident. Now the whole globe is well connected and continuously communicated. So in that sense, is not much of a difference should be seen from the perspective of an investment where the allocation should go. However, your question is whether NRIs are enhancing their investment out of the portfolio towards India. Yes, specifically towards the real estate and financial assets, it is increasing. If you go by the remittance figure, global remittance, a huge $135 billion. That is a year-on-year growth of around 14-15%. And earlier, the UAE used to be the #1 country, but I think last couple of years, US has outweighed this nation. This money is coming. Out of the money which is coming from investment, not consumption and all, 40% of that going to real estate, 20% going to stocks, 20% going to fixed deposit, insurance, etc. Remaining mutual funds and businesses, money is going. And it is increasing every year. So if you see, going by the inside of the people, survey reports and estimates, maybe around 20%, 5 to 15, then around 20% people are allocating towards India. But what Akhil told, what throughout the day we have been listening, and the trend is very clearly towards India. And it is not only applicable to NRIs, but anybody who is looking for investments, and everything is open. So what only two things difference is your forex related issues and what other option is available. But everybody should look towards India, and India is a clear growth story. We have been listening that, and it demonstrated that. So many factors, right from Madhu, and everybody has told those growth-oriented economy, the demographic dividend, a young country, and well-governed, and so many entrepreneurs now coming. And to it, manufacturing and innovation will come in. That cannot wait. So that will come. And so far as your future-proofing word is concerned, I have some issues. We call it the proof, something proof like termite proof. Future is not a bad word. So future always will be better than present. So let us call it future aligned. Whatever will be there, we should not miss out that opportunity. We should also be able to go. So for that, our present investment need to be liquid, need to asset allocate in such a manner that we grow maximum, and when the new opportunities come, future opportunities, we can transfer there and so. So we are not afraid of future. We are not running away from future. We are aligned to the future. Thank you.
Yeah, that's a great way to put it. So we can call it bulletproof future aligned strategies, if that's something that works.
Yeah, that will be better. Thank you.
So Pratik, so I know that you look at global macro allocations very regularly. So would you say that there is a thumb rule for this allocation? And also, how would you size global economies? Akhil spoke about India, and Debashish mentioned that we need to increase from the 20%. So how would you size other economies in comparison to India?
I think firstly, it's a bit more technical. One has to be valuation conscious. The other thing is that we need to understand what are the missing points. Yeah, India is great. I don't need to talk about India growth story. Both of them are very bullish. Prashant delivered a great speech this morning. There are enough number of people at any point of time who would be India bulls. So am I. But at the same point of time, let's not pretend that all the right investment opportunities and pockets only exist in India. What is the missing piece today in India? I think Pramod gave a presentation. He spoke about two of his funds from Marcellus. He spoke about the global fund, right? He spoke about NVIDIA story. He spoke about tech. Now, where are we with respect to tech? Where are we with respect to semiconductors, with respect to AI, with respect to deep tech, right? Robotics. So if we think, arguably, the best stock of India is, say RIL, HDFC, I'm just saying, assume. Understand the size that we are missing out on. What is India's GDP growth today? GDP, $4 trillion. What is NVIDIA's market cap today? $4 trillion. Try and understand the missing piece. So if one says that I want to only invest in India, and because it's a great market, then obviously one is missing out on a lot. From our perspective, I think we have been very neutral. We don't have any kind of biases. We don't have domestic market bias. We don't have American market bias. We take it as it comes. We found a great story in tech. We figured out that India is not there with respect to tech. We invested in semiconductor. We invested in AI and robotics. We invested in world tech, basically. Most of them were taken through the ETF route because we are a great believer in being cost conscious. And at the end of the day, it is empirical that 85% of the returns are delivered because you are in that particular asset class and you're riding that asset class wave, right? And only 15% could be attributed to your stock selection. So if I am in an ETF which invests in, say, top 50 deep tech companies, I'm not too bothered about timing or stock selection. Do I have NVIDIA in my portfolio? Do I have AMD in my portfolio? It would by default be a part of that, right? So I would say that about 15% of our portfolios are in tech from a global standpoint. We found great value in China last year. It was a contrarian call. When we picked up China, no one believed in China. 2024 Jan is when we picked up 5% in MSCI China ETF. It delivered negative 10% returns. In the next 6 months, we added 5% more. Another 6 months, it delivered 15% returns. We added 5% more. That's the brightest looking spot in our portfolio, and I think we were the only bull in a market full of bears at that point of time with respect to China. Doesn't say that all our calls go right, but as I told you, we are quality conscious. We are risk managers. We try to understand what markets to avoid, which pockets to avoid. We don't have fear of missing out. We missed Japan, quite happy about it. Doesn't matter. We don't have fear of missing out, so we are not in the frontier markets. We are not in asset classes that we don't believe in. We put a lot of emphasis on liquidity. Having said that, we don't say that India should not be a big part of the portfolio. Of course, at this point of time, in the global portfolios, 45%, 50% in our NRI segment still is invested in India. But at the same point of time, as I told you, that we picked up gold, we picked up tech, we picked up China, we picked up 5% Europe as a pure allocation call. Something I also aligned with Pramod, because he said that in his fund, he's underweight large caps and overweight small and mid caps. We have also been overweight on small and mid caps in the US, specifically to play the rate cycle, and that's augured well. And in the small and mid caps, we have gone through a fund because the Russell 2000s of the world, 80% of it, too many stocks, we believe are laggards. So that's where we thought that alpha is important, hence we went through the fund route. So to answer your question in a nutshell, we are well diversified. In his initial, I'm again and again going back to Pramod because he kind of touched upon things which I completely believe in, and I think all fundamental analysts do believe in those things. Diversification cuts risk, right? Yeah. So you cannot think about maximization of returns. You also need to think about optimization of returns. You need to think about volatility. You need to think about being in space where the opportunities exist. So from my side, it's a truly macro allocation.
Great, great. That's a completely different view from a perspective that while we need to keep improving allocations to India and double down on the compounding that's happening over there, we need to keep an eye on the global markets as well. So very well summarized, Pratik. Thank you. So we spoke about where. Now let's see how to do this. And Akhil, coming to you, NRIs have India mid-caps, they have thematics, they have alternates, and on the global side, there is global fund managers. So what kind of products do NRIs look for? Should they focus on, from an equity perspective?
Closer.
Sure. So what kind of products or what channels are reflecting this shift?
Yeah, so over the last couple of years, we are definitely, okay, so let me put this way. Uh, so let's say today itself, I've met a couple of private bankers in the town. And because we had this session, so I was asking them that generally, how do NRIs invest? Right, because these guys manage some rich guys. So typically what I got to know is that Indian equities would be typically less than 10%. It is supposed to be a core allocation. We come from India, dal do, buy and hold, finish it, forget it, right? 90% of the NRI investments actually is exactly like what Pratik has been talking about. It's in US direct equities, US ETFs, Europe, global ETFs, structured notes, fixed income, leverage. A lot of things were going over my head also, right? So this is a typical asset allocation platform of a NRI all this while, right? But what we are seeing over the last 3 or 4 years, being in asset management myself, is definitely that even the NRIs are getting a lot of confidence in India. So I would believe that they are under allocated to India because of past experiences. Every time they would have come, they would have had a bad experience in the past. Could be real estate, bad deals, it could be putting money in fixed income going bust. It could be investing in equities and then the rupee depreciation hitting you. So every time they have come to India, they've actually lost, if you see last 6, 7 decades. But over the last 4, 5 years, clearly that confidence is coming back with, like we discussed, the macros are looking stable. I mean, you look at the India corporate story also, you are on the private credit side. I mean, 10 years back, you just had 2 or 3 sectors where you could put your money on. It could be consumer, it could be banks, it could be pharma, or maybe some more defensives. Today, you have like new age businesses coming up, you have capital markets, you have NBFCs, you have infrastructure, defense. It's actually broad basing. To a large extent, I think India is a lot more less beta market than compared to US, because US largely for over a decade, the whole growth story has been based on the FANG companies, and now it is all about the AI companies. Rest, all of the stuff is growing at a very moderate rate, right? But in India, you choose what you want to choose, and you find growth everywhere because of the base. I mean, we are very young. Everything is very tiny. He's spoken about our largest company being 20 lakh crore market cap, and our economy being 4 trillion, and Nvidia being 4 trillion. Great. That is the room to grow. When our #1 company will become $1 trillion, that is the growth we have to participate here, right? So, yeah, that the asset allocation pattern is changing. Confidence is coming back. We are seeing a lot of money coming through NRE, NRO accounts into mutual funds, into PMS, AIFs. Our subsidiary company has private equity, real estate. We are seeing $100 million, $200 million coming into alternate assets as well. We've started our gift city. We've got, I had a Mauritius fund. We launched it in 2016. In 10 years, we could raise only $30 million. We launched a gift city fund a year back. Today, we are at $200 million, right? So, it's just that, suddenly the thought and the comfort of the NRIs is actually coming back, right? So I think it's early days. India is terrifically under-allocated, which is the case I'm trying to make, is that, here is there, you have a 20, 30-year opportunity. Things are looking very good from a lot of perspective. We'll talk about it. But yeah, we are seeing that shift happening slowly, steadily. And with these platforms and the way we are coming and talking, hopefully we get more allocation out here.
Yeah, no, definitely. I think the possibilities are numerous now, and it's about identifying the right platform to be able to go with investments allocations. Debasish, now, just one important question to you as people try to navigate this. So this is getting, in some form or shape, investors are sophisticated, they have different needs. So would you say, is there a future for DIY, or is it going to be continue to be distributor-led?
First of all, this DIY, I have a different nomenclature. See, if it is do it yourself, that is a very short-term transactional perspective. The D stands for decide it yourself. There, the advisory, intermediate, all these things will come in. See, any business, technology will change, come and go, new things will come. The fundamental economics behind the business will remain constant. In our business, it is the invisibility, it is the intangibility, and it is the complexity, and the problem of options. So many options are there. So for that, I may start something just to experiment, But to continue with that, in fact, the story starts after the transaction, hand-holding, the emotional bias, the behavioral bias, this cannot be reinforced by the person doing the same things. It required to be diluted. So for that, it has to be a mix up these things. Always there will be mix, but people will create a fear that DIY is coming, so distributors will not last. This is absolutely misplaced. Why? First of all, even in our Indian mutual fund industry, you will see, you take out the institutional businesses first, which is 45, 46%. There has to be direct. There are treasury officers, CFOs, they decide on the corporate's investment, liquidity and all. Then all those EPFOs, coal miners fund, PSUs and all these things coming through ETF and others, that has to come directly. You take that out from the rest part, which is 50%, around less than 50%, the direct incrementally coming will not be alarming. And if you see, they were calling Gen Zs are very techno-savvy and all these things. Do they not seek advice for their destination wedding? Do they not seek advice for their education? Everything they seek advice and pay for it. And why not for investment? This is just, I think, it's either narrative being created to undermine the contribution of the distributors and these things. See, whether it is a distributor or a banker or an intermediary and RI and whosoever, there are somebody is there. In 24 hours of life of a human being, you get triggered to do something. In the morning, you feel like getting coffee, so coffee is ready. You feel hungry, food is ready. You feel cold, so blanket is ready. You feel sleepy, so bedroom is ready. You don't feel buying SIP in 24 hours. Somebody has to convince it, casual it, you understand it, then will you do. So the role of advisor or intermediary will be there as long as future remains uncertain and this financial matter is dynamic and complex. That will be there. So I think the healthy mix will be there. Let people learn them. Perhaps, for example, a person like Akhil or Pratik, they may do like direct because they otherwise also they are aware about the choices. The optionlessness is not bliss for them. But for other people, they will definitely seek, if they try also DIY first time, they will go to the platform when they grow their wealth. I can't manage this, let me give it to somebody. So that fear is not there. And for NRIs or non-NRIs, for US also it is maximum 11% who are non-advised. So it will remain so. So I always tell MFDs, this business will not go away. Thank you.
No, definitely. So if you can seek relationship advice from your friends, definitely talk to your distributors, talk to wealth advisors and understand the best ways to allocate portfolios. So Pratik, just to maybe bring this all together and integrate this with a global life of an NRI. So they juggle education abroad. There is a lot of multi-currency expenses. How can NRIs align assets with their future currency liabilities?
Very difficult. I know it's a very different view. A lot of people, a lot of hedge funds work on currency hedging. Now imagine a person, HNI, earning in US dollars. Maybe he's earning from Dubai, which is pegged with US dollars, of course. He has a second citizenship, which is in the UK or Europe. So a large part of his monies gets spent over there in a different currency, which is Euro or GBP. He obviously has ties back home in India, so he also has maybe some liabilities or assets or investments in India. Now, how do you hedge all these currencies? And I'm just talking about a overtly simplistic case with just 3 currency exposures, right? People could have businesses in different other regions as well. So what I say is that instead of trying to hedge the currency risk, how can you take the currency risk out of the play completely? Okay. Now, most people would agree that they need to hedge the risks to protect their purchasing power, right? Or rather spending power. So if the majority of my spending is in a particular currency, which is say euros in this case, how do I make enough euro returns which can hedge my currency risk and hedge my inflation risk, right? And allow me to retain my purchasing power. So that's where I believe that one has to look at growth markets, especially India, and that's where my thought process aligns with my home country bias, that as long as you invest a substantial capital in a growing economy, and I took this example before in the earlier session, and again I'm going to repeat it for the greater part of the audience, because what's your expected return from an economy? Your average GDP, plus your average inflation, plus premium for corporate profitability, plus or minus the currency appreciation or depreciation. Now 6.5% conservatively, plus 4.5%, 11%, plus 3%, 14%, minus 2 to 3%, you're back to 11 to 12%. That's your outlook for the Indian economy, the returns, basically. Now, in dollar terms or euro terms, I think shave off 2 to 3%. So you're back to that 10% kind of mark, returns. I would say it's not an optimistic assumption. It's a very normal assumption, because I think a lot of us do believe that the Indian currency could depreciate by far lesser than what it had in the past couple of decades. So now with your 10% dollar terms or euro terms returns, can you beat your inflation even in a high inflationary environment? The answer is yes. Are you satisfied with the growth? Does it cover for some growth net of inflation? The answer is yes. So all I'm trying to say is that, now I again gave a very overtly simplistic example of investing only in India, but I'm saying if you work with smart advisors and you know fundamentally which are the economies that you should be in, which are the pockets you should be in, can you take part in NVIDIAs of the world? Can you take part in a China when the valuation is single digit, right? I took an example of China. When we invested, the P was 9P multiple at that point of time. So if you do invest with tax-conscious, cost-conscious, fundamentally driven asset allocators, you could improve upon that return by 1 or 2%. So if you could make a dollar terms 12% return through these smart choices and thoroughly researched ideas rooted strongly to fundamentals, I think you take the currency depreciation or the currency risk off the play completely. And that's what we aim at.
Just explicit hedging. It's active strategization.
The cost of hedging is a lot.
Yeah.
When people actually try doing it, you would feel that you're losing more than gaining anything. And I mean, what does purchasing power parity say? That in the long term, hedging will not make meaningful difference. Okay, so we just follow it. We just try to take the currency risk off the table and protect the purchasing power of the client. That's about it.
Yeah, that's a very good strategy. So now, summarizing all of this into portfolio construction, and Akhil, I'm going to take your, maybe thoughts on how to construct or design a model portfolio that is, that includes India in the allocation that you would want, but also sort of looks at global, US AI, for example, Japan, or global healthcare. How would you sort of build in that portfolio?
So if I have to think, let's say for myself, I'll keep it simple. I'll go 50% US and 50% India, right? And I'm actually trying to do something like that.
Okay.
Within US, of course, people may argue on valuations, etc. But there are some spaces which are really coming up. They could go through some amount of volatility, corrections, all that stuff. But there is a long-term story building up on the AI front. A lot of ideations over there. So probably I'll try to max out US for the tech expertise they have, right? And apart from that, honestly, like Pratik spoke about, probably would look at a little bit of China as well, but yet to get comfort on economy and long term and all that stuff, but can't miss that given where they are. One thing which I don't know about the NRIs, but all of us have missed out, at least in India, has been the gold and silver. So I think that 10-20% static allocation to, because this whole geopolitical thing, tariffs, whether your central reserve currency will be dollar, or it will be gold, or it will be some digital currency, or it will be crypto. Nobody knows anything in 10 years what is going, right? So I think natural, and now on a 10-year basis, gold is actually higher than the Nifty 50 returns. So commodities like gold and silver also needs to be a part of the core allocation. So US, some amount of China, lot of India, and a little bit of commodities. This is how I would probably look at. I'm not a fixed income guy, but yes, maybe there is a space of, like I think Pramod spoke about dry powder. So 10-15% dry powder, because at these valuations globally, some bad news and everything is going to fall off the cliff. So if that time you have 20% cash, you will be the king. Yeah, so keep that also. This is what the way I would think.
No, that's a great strategy, and people should be taking copious notes on this. Debasish, so from a mutual fund perspective, given that you have deep expertise in the segment, which segment of mutual funds would you say is investable from a volatility perspective, from a low volatility perspective, and would give NRIs some peace of mind given that they cannot track the markets as well as local citizens can?
So after listening to Pratik and also to Akhil, my job is very clear, very easy. A multi-asset allocation fund. See that uncorrelated asset classes, and even if you see last 15 years or since even last 30 years, gold appears to be better than equity in terms of low volatility, low drawdown, and equal, if not higher, return, CAGR. And here now onward, specifically the global geopolitical uncertainty is diversification of reserve by central banks and supply remaining constant and demand from the new affluence classes in all populous countries like India, Indonesia, China, Pakistan. So the first sign of somebody getting neo rich is buy gold. So demand going up, and so much of gold getting bought by central banks and locked up in the stock. Even when we launch an ETF, equal amount of gold is bought and out of circulation. So gold supply will be constant and demand will go up. So gold will be an asset class. So equity, debt, gold, little bit of foreign equities, REITs, crudes and etc. other commodities. The multi-asset is a beautiful combination, and in fact, it should form 25-30% of everybody's core portfolio. And beyond that, you allocate depending upon the risk profile, and this fund will give you low volatility, higher Sharpe ratio, and better CAGR or potential of better CAGR. So peace of mind you are talking about, that can be achieved by this.
Great. I think this panel has given a clear strategy as to what to invest in. We'll summarize this with actionables too, but moving to Pratik, and something of importance too is risk engineering. So you must be looking at a lot of that. So what would you factor in when you're designing a portfolio from a risk perspective? What are the risk weights that you'd give to growth, stability, currency across geographies?
Okay, to analyze the risk, obviously, at least we have our financial risk managers in-house. The focus is on trying to understand what's the value at risk, what's the maximum drawdown, the scenario analysis. All those are technical, but let me put it from a qualitative perspective. I think we'll put a lot of weight on cash flows. So, I told this in my previous session as well, that I don't understand too many things, pretty dumb that way, but I understand cash flows. I put a lot of emphasis on cash flow positive businesses. And I don't want to invest in pockets where a loss-making company will become a large profit-making company, and hence I will ride through that. As I told you, I don't have expertise in that. That's number one. Number two for me is growth, but again, the growth cannot come at the cost of cash flows. Okay, so it has to be a cash flow positive business or cash flow positive portfolio. We do take contrarian approaches as well. So at the helm of things, how we construct a portfolio is basically we understand a client's profile, which is his RRTT LLU, his return expectation, his risk appetite, his taxation, his time horizon, his liquidity needs, his legal constraints, his unique preferences. We marry it with the capital market expectations. We try to understand that by marrying this, what is the minimum level of risk at which we can deliver the expected returns. Okay, so there goes your volatility. Now, once we have done that, then we try to build a core portfolio around it. A satellite portfolio would be more opportunistic ideas, like, as I told you, China, some allocation towards Europe. I'm not saying we don't go wrong. We went wrong in trying to play the interest rate cycle by being in the longer end of the yield curve in the US Treasury. I'm not saying that we got rogered, but we exited out flat after 1.5 years, and I believe that the yields, the yields will not get realized what we kind of targeted for. So anyway, that's another story. And then we retain a bit of tactical leeway. So that's about 10 to 15% of the portfolio. So instead of leaving the fund manager or a hybrid fund with the choice of asset allocation, we retain the asset allocation decision with ourselves. And that's why that tactical leeway is in play. So there are times when we go overboard, whether it's with respect to small caps, with respect to tech, with respect to a geographic allocation. And there are times when we go underweight. So that's the crux of it. And it's a very scientific process. It's an empirical process. There is method to the madness. There are various ways of making money. People have made money from crypto. People have made money from gambling. I know only one way of making money. In the longer period of time, can you invest monies, go to sleep for 20 years, wake up and be positively surprised that all your expectations have been beaten? That's what it is. I also look at shortfall risk because that's very important when one is looking for investing for the longer period of time. With respect to his goals, so we do a statistical analysis. What is the 99% probability that the person will meet his retirement goals? What is the 70% probability? What's the 40% probability? And accordingly construct a very comprehensive asset allocation idea, which is obviously managed in a very comprehensive way in consultation with the family and over the longer period of time.
Great. So curating risk-managed portfolios with the understanding of age and long-term plans of the individual or the family office is very important. So I am going to wrap this up with a rapid fire. I am going to ask each of the panelists one simple question, and that would be a very crisp, actionable. What should NRIs do, right now or within the next 90 days, immediately to be able to blend their portfolio, add some mix of India or global or however it is? What is the one thing that they need to do right now?
To me? There's no one thing that can actually satisfy, and everything's in the hindsight, right? But I think stay true to allocation, to valuations. At this point of time, India is trading a forward P of 22, 23P multiple, which has come down from being very expensive to moderately expensive. India has always been an expensive market within its Asian peers. It has always traded about at a 90% premium. Today, it's at about 45% premium. So I think it's an acceptable valuation. There could be pockets of overvalued and undervalued stocks in mid and small caps, depending on how you analyze it. So there are pockets where I think there are opportunities in the mid and small caps in India that should be looked at. There are enough reasons for me to believe that defense as a sector could do well. There are enough reasons for me to believe that export as a sector will not do well. So be in such kind of pockets. In America, I don't think that one should completely move towards large caps or one should completely move towards tech. It has to be a diversified portfolio. See, for us, I think the timing of money is very important. I'm not saying I can time the markets, no one can. I'm saying at the point of time the monies are coming in, you analyze what's the best possible option, staying very rooted to valuations. That's the god of everything, valuations. And at the same point of time, don't miss out on, don't be a fence sitter. So if you believe that valuations are comfortable and this is a core part of my portfolio, hold it by all means for the longer period of time. You don't have to keep changing between asset classes, between geographies, unless, also you have to look at transaction costs, taxes, etc. So, to sum it up, 45% to 50% towards India as an NRI client, remaining diversified across 15% in tech, 15% in China, 5% in Europe, and the remaining in a blend of small mid caps in America. That's what my portfolio would look like.
Great. We should, you should probably post this along with the, Prem, you should make sure to post some of these ideas. It's very important. So how about you, Debasish? What would be the one thing you would ask everybody to go back and do in the next 90 days?
So I will suggest then don't wait for 90 days. Within 90 hours, seek advice, go for a second opinion, see whether your portfolio has drifted away, and align it to your goal. Check, is there any regulatory and legal update which you are running behind? Check your KYC status and make clean statement. If you are not nominated, nominee, create nominee and clean.
Right. No, definitely. Some of these operational things might seem like, something we can delay, but it's very important to make sure we're up to speed on that. And how about you, Akhil?
I think broadly they are doing fine, but still, if what I see here over the last 24 hours is a lot of excitement for artificial intelligence. So if you are overtly allocated, cut your allocation. I hear a lot of leverage on risky assets like equities, fixed income, I don't know what else. So try and cut your leverage in the current environment. Uh, I think it's good to have 10-15% real cash for any global uncertainty. Anywhere you have deep correction, even if it is US, at least you can go inside. A lot of people actually bought into Nvidia and all of these stocks when they corrected and they've made some. So there could be some good arbitrage available, but you need to have cash for that. And I think if you see typically every year winners will rotate. So different asset classes outperform each other every year. India has underperformed everything, virtually everything. Indian stock markets have virtually underperformed everything. So valuations look much more better than what it was a year back. Recovery in earnings growth. Probably next calendar year, India has the potential to outperform. So if you have if you want to rebalance your portfolio, maybe you can increase your allocation a little bit on the India side, but cash, cut off risky positions, neutralize, normalize your portfolio. I think these would be some of my suggestions.
Definitely. I think today we've heard a lot of good insights on how to create a future aligned portfolio and make sure that there is enough of India and some level of diversification from global too. So India is the growth engine that provides the compounding, and our global diversification is the wings that take this ahead from a currency stability perspective. And a seatbelt would be the good behavior that investors need to show to make sure that they're protected from all turbulence. So I think I definitely...
Just a disclaimer, sorry. None of this should be construed as investment advice.
Yes,
This
absolutely.
is all, talking from my perspective. Everything would obviously depend upon someone's personal situation
Yeah,
and
but
profile.
I think the people in this room are very lucky to have heard this. So definitely noted with the disclaimer. So thank you, Akhil. Thank you,
Thank you.
Debasish.
Thank you,
And
Archana.
thank you,
Thank you.
Pratik,
Thank
for such
you.
a remarkable session.
Thank you, sir.
Thank you very much. Thank you to everyone who stayed back, a handful of them.
Thank you, Archana, for doing such a wonderful job. You really brought out the key insights which we discussed through the day, and you put them all together. So it was really wonderful. Thank you, Akhil. As always, you were very forthright, you were very simple, you were very direct. So that was wonderful. As always, Debasish, you were insightful, and you always champion the cause of distributors and wealth managers. That is a consistent thing that I know you've been practicing. You're so passionate about it. It's very touching to see that. And Pratik, your understanding of global markets, I think I'm quite impressed by that. We've had conversations about it earlier also. But today you've reaffirmed the fact that this is really your passion, this is your calling, and I think you are in the right place at the right time. So all the best to all of you, and thank you for being such a wonderful panel. I'll just ask you to hold back for a minute. Akhil?